Hi, everyone. This is Jeff Praissman with the Interactive Brokers Podcast, and it's my pleasure to welcome back to the IBKR Podcast studio, NASDAQ's Michael Normyle. Hey, Michael, how are you?
Doing well, thanks. Glad to be back.
Thanks for coming by. I always appreciate our monthly podcast we do on the economy. And today we're going to revisit a topic we originally discussed back in July of 24 in episode 170, Rich Man Spends, Poor Man Can't Save. And it was about what we call the K-shaped consumer, which is high income net worth households doing well due to faster wage growth and stock market and home appreciation. And then on the other end of that, the low net worth and income households struggling with spending a larger percentage of their wages on goods and services. So Michael, how have the economic experiences of lower income households changed over the past 15 months since our previous podcast? And how do these shifts compare to those seen in wealthier families?
Yeah, so like you were saying, 15 months ago, we were talking about how lower income households were starting to struggle a bit because they had run through their COVID era savings during the period of high inflation that we saw in 2022 and 2023. Then they started to see real income growth slow as the labor market cooled and income growth became their main source of spending growth. Since then, we've mostly seen these same trends continue, if not worsen. So wage growth has slowed further at a time when we've recently seen inflation picking back up a bit. The Atlanta Fed shows 3.6% nominal wage growth for the bottom 25% of Americans, but CPI inflation is now rising at 3%. So that means just 0.6% real wage growth. And that might even get squeezed a bit further in the coming months as inflation is expected to rise a little bit more from here. For people on the higher end of the income spectrum, 15 months ago we were talking about continued strength since they have money to save, so they were actually benefiting from the Fed's higher rates, and they were benefiting from a strong stock market since the top 20% of households own 87% of stocks in the US. Today, this more or less remains in place. We have stock prices and home prices near record highs. That creates a wealth effect for higher income households, and that's continued to support spending. And the top 20% of households do about 40% of spending in the US.
And so obviously these wealthier households are just on a different track than the poorer households as in what they're able to save. But how has income growth changed between the lower income and the affluent households over that time period?
Yeah, that's a big area of difference in wage growth. So for the bottom 25%, their wage growth has slowed steadily from 7.5% in late 2022 to 3.6% in August of 2025. For the top 25%, their wage growth peaked at a lower level and later. In mid 2023, it peaked at 5.7%, and then it fell to 4.7% by the spring of 2024. But instead of continuing to fall like we've seen with the lower end of the income spectrum, it's mostly moved sideways the last year and a half. And so it still stands at 4.6%. So instead of falling wage growth for people on the higher end, it's pretty much been moving sideways.
And I would assume that rising prices and inflation really affect the lower income households much more significantly than the higher income households. As far as daily financial management in these lower income households, how are they doing versus the wealthier ones? Are they making any headways or catching up at all?
Yeah, you're exactly right. Inflation, it's especially a challenge for lower income households just because they have less cushion to absorb it in terms of both income flows and wealth. And so where we're seeing inflation also matters too. So lower income households, they spend a larger proportion of their income on things like housing, energy, and groceries. Those were all top sources of inflation in the post-COVID inflation spike. Fortunately, we've seen housing inflation slowing the last couple of years, but still lower income households, they spend a larger proportion of their income on goods. And of course, this year we've also seen a revival in goods inflation. And then lastly, inflation does impact higher income households, but they have more cushion to absorb it between the higher wage growth that we've seen recently. And then their spending is also more tilted towards services where we've generally been seeing inflation slowing in the last year or two.
Yeah, and that really actually just touches on my next question, which is how the spending habits and priorities evolve for these lower income households and the wealthier families amid these changes. And judging what you just said, like it seems to me that the lower income families really their priority is just, treading water basically, if they can, or at least not sinking too far down where these wealthier families seem to still have a cushion where maybe it hasn't affected them nearly as much in their daily day to day. Is that kind of a fair answer?
Yeah, and I think one of the big stories that we've seen, and it's really been highlighted during the earnings seasons we've seen in the last year or so, is one of trading down, where consumers increasingly opt for store brands or they start shopping at a cheaper store. And so this also means an emphasis of spending on essentials instead of discretionary spending. So even just from Q3 earnings that we just had lately, right? The CEO of McDonald's noted that visits to fast food restaurants by low income households fell again in Q3, and this is a trend that's been going on for 2 years. Meanwhile, higher income households, they seem willing to keep spending even on discretionary purchases. Just recently, there was a Wall Street Journal article highlighting that the average daily room rate at luxury hotels in the US rose to a record $394 per night. And that's because it's seen resilient demand among those higher income households, while rates at economy hotels have been flat for about 3 years. And then just recently, some research from Apollo showed that the S&P 500 consumer discretionary sector is up about 10% since June, while the consumer staples are down about 5%.
And to your point too, I know Target just came out with their earnings a few days ago, and they had a pretty bearish outlook as far as the holiday spending. And be interesting to see when Walmart comes out in a few days. What are they getting? Are they optimistic? Are they getting those prior Target customers? To your point, spending down a little bit and seeing where they're at. And so now I want to more concentrate on these wealthier households, right? Because the stock market rise, housing appreciation, and so forth, it really causes a wealth effect, right? So even if people don't have any actually more cash, they see their 401ks, they see their savings accounts, they see their individual brokerage account, and it looks great, right? So it's a psychological, effect for most people, and it really does it for people with higher net worth. What might happen if all of a sudden the consumer behavior differ, if people began recognizing these paper gains and all of a sudden the stock market goes down? Do you think these wealthier households will see the effect and dig in a little bit more?
Yeah, so just to put some numbers on it, there's research that shows for every $1,000 that a person's stock portfolio goes up, people might spend about $35 to $50 more than they would have otherwise. So that's that kind of wealth effect that you're talking about. And JP Morgan estimated that the wealth effect from the gains in the top 30 AI stocks alone accounted for about 16% of the increase in consumer spending in the past year. So the asset price appreciation gives those consumers that confidence to keep spending, like you're saying, that psychological impact. But of course, based on that $1,000 estimate, we're talking about 3.5 to 5% of that paper gain. So it's not exactly like people are going nuts here. They're boosting their spending a little bit, but hopefully it should be something that is still within reason. But when you consider that 16% of consumer spending being attributable to stock market gains, then, like you brought up, a swoon could definitely dent spending growth. I don't think we'd see spending growth going negative, but the pace of growth could slow certainly.
And I'm pretty sure I know the answer to this, but I want to ask it for our listeners. Are there notable contrasts in household debt levels and borrowing practices between these two groups? I'm just going to go flat out and say that most likely the lower income housing are probably seeing taking on some debt that they don't necessarily want to take on just out of necessity.
Yeah, and this is the place where I think we have to make some imperfect assumptions since income levels don't map perfectly to credit scores.
Mm.
But lower income workers, they're more likely to have lower credit scores. And sometimes that's just because they're younger, they don't have as much credit history. But recently, what we've seen, subprime auto loan delinquency rates actually rose to their high since at least 1994. That's the full history that we have, and it's the highest in that history. We've also seen credit card delinquency rates rise to some of their highest readings since the global financial crisis. So it's clear that people are definitely struggling to keep up with payments, and this is likely a bigger issue among lower income households. And then on the flip side, if you look at delinquencies for mortgages, they remain very low. And in part, that's because people, they refinanced during COVID, they locked in historically low rates. And it's also partly because after the global financial crisis, lenders boosted their lending standards. So mortgage borrowers were much more creditworthy on average. And then
Mm.
lastly, when households know that they need to miss a payment on a loan, the mortgage is the last resort.
And we really touched on this in our last podcast. It was basically the title, Rich Man Saves and the Poor Man Can't. But in terms of savings and investment, has anything changed over the past 15 months, or is it really still that the wealthier households are able to take advantage of being able to save, have these lower income houses made any headway, or has it actually gotten like worse for them as far as being able to put any money away?
Yeah, it's definitely been a challenge for lower income households. There's research from Deutsche Bank that shows real liquid assets are below pre-COVID levels for the bottom 20% of US households, while for all other, the top 80%, it's up for all of them. And going back to those top 30 AI stocks that I mentioned earlier, so JP Morgan, they show that those stocks alone have added $5 trillion to household wealth in the US in the last year. But again, you have to own stocks to gain that wealth. And again, the top 20% of households own 87% of stocks. The good news, though, is that we've definitely seen a shift where lower income people are starting to invest more. So they're starting to benefit more from stock ownership. So data from JP Morgan Chase Institute shows that as of May 2025, the share of people with below median incomes transferring funds into investment accounts was about 5 times higher than the average over 2010 to 2015. And then the monthly investing share for above median income individuals was up threefold. And lastly, people are investing earlier. So the share of 25-year-olds in 2024 that used investment accounts was 37% compared to just 6% in 2015. Again, looking at 25-year-olds in 2015 versus 25-year-olds in 2024.
It actually leads me into my next question almost perfectly too, is what role does the access to credit and financial services play in shaping the experiences of both these household types? So it sounds like from what you're just saying, that some of these lower income households are actually starting to invest more and potentially be able to really take advantage of the economic environment if it stays as is, in the
Yeah.
future.
That's definitely true. But I think to your initial question, right, access does matter and it adds challenges for lower income households. So for example, since like we mentioned earlier, higher income households, they're more likely to own homes. If they need to make a big purchase, they can take a home equity loan. For people who don't own homes, that's not an option. And that means they're going to have to rely on credit cards most likely, and those carry much higher interest rates. So right now, a home equity loan, the rate is about 8%. For a credit card, it's 20% or higher, especially if you have a lower credit score. So it adds the financial burden both by restricting your credit options and then increasing the interest expense.
Yeah, and I would assume too, utilities and just general cost of housing takes, we really discussed in the beginning, bigger bite out of the lower income families' budget compared to the wealthier ones. But in what ways do the lower income and the wealthier families experience the effects of economic inequality and the growing wealth gap since we even last talked, or just in general? What other effects are there besides just with the lower income families really just struggling to stay afloat?
Yeah, just to address your housing and utilities question quickly, there is data from Harvard that shows 20 million homeowners, which is a quarter of all homeowners, were cost burdened in 2023. So that meant that they spent more than 30% of income on housing and utilities. For people making less than 30,000, nearly 75% were cost burdened. So like you're saying, these housing and utility costs are really a problem, especially for people on the lower end of the income spectrum. And for homeowners, you've seen property taxes rising with the value of homes, increases in insurance premiums as well. For renters, it's 22 million people that were cost burdened, and that's half of renters. So this is definitely an issue, like you're mentioning, for especially for people on the lower end of the income spectrum. And then when you're talking about the effects of inequality and the wealth gap, it's definitely a problem, and not even just for lower income households. So there's research from Jefferies quite recently that showed that the top 1% have more wealth than the middle 20 to 80%. So it's not just people on the low end. And then for housing, home builders, they aren't building entry level homes as much. So it's harder to become a homeowner just because that entry level price point isn't there. And then even on what we were talking about earlier with travel, where lower income households, they've been reducing travel spending while higher income households have been boosting it. We did see some progress during COVID, though, with the wealth gap narrowing, and that was the combination of those stimulus payments that we saw, the stronger income growth for lower wage workers, but those effects are definitely starting to fade again more recently.
And looking out to the future, what trends might either make this gap worse or bring them together a little bit and take that K and bring those edges in for the economic experience of both like the lower income and wealthier households?
Yeah, I mean, I think there's a lot of dimensions in which this relationship could change. So I'll just focus on a couple here. So a continued asset boom would probably exacerbate the gaps like we've seen recently. But as I did mention earlier, lower income workers are participating in markets more, so that should help at the margin. And then rate cuts from the Fed could certainly help, right? To the extent that helps boost the labor market, which then helps boost wage growth. Plus, if we see inflation cooling off over the next year, which is my personal expectation, that should help with real income growth rising as well.
Michael, this has been great. Again, appreciate you stopping by the IBKR studio. And for our listeners who want to get more from Michael, you can find him at NASDAQ.com as well as on our website. Click on education, and you can find many great collaborations with NASDAQ, whether it's webinars, podcasts, articles. And until next time, thank you.
Thanks.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.